Coming up today, stocks finish the week mixed, what's holding the market up, more government debt, Cathie Wood's prediction, Germany legalizes cannabis, and I'll show you a couple of my spread trades. And so it was a soft day to finish the week. Bit of bearish breadth across the board, especially coming out of financials. A little bit in cyclicals and industrials as well. Well, it was really mega cap tech that stood out from the rest of the market, with the biggest of them all, NVDA, climbing again up 3%. And the momentum in this name continues. Actually just put in its highest close ever, and would not be surprised to see it hit $1,000 a share for the first time ever next week, on the back of their really hot AI conference this week, releasing their new Blackwell chip. Definitely giving the market every reason to keep running here. And if we were to hit $1,200 in the coming weeks and months, that would make NVIDIA the biggest stock on the planet, with only Microsoft and Apple currently in front of it now. And there's a composite chart of the Magnificent Seven, actually finishing up 1.29% today thanks to NVIDIA, with all other indices finishing lower. Really slight low range pullback day on the S&P 500, and a bit of volatility in the small cap space, down 1.38%. There's a bird's eye view for the trends in the market at the moment. Pretty much green across the board in all risk-on sectors. Just a little bit of weakness in healthcare staples, showing this is really a risk-on market we're in now. Volatility's downtrending, yields are downtrending in the short term, and a little bit of a pullback in oil and gold as well. And just looking since the start of this year, in the red line here is the momentum factor ETF. Seeing that the clear winner so far this year. Starting off with a rolling 12-month return of 5.5%. Here we are today, the momentum factor up 40% over the last 12 months, really outperforming dividend shares and low volatility shares, while growth stocks still holding up there as well. Leading sector today was semis, aerospace and defense, with the losing sectors today regional banks and clean energy. Okay, so today, before we get into all the news, research and data, I'd like to share with you guys a few of my spread trades I'm currently in and have been watching. And for those of you who don't know what spread trading is, it's also called pairs trading. And in TradingView, you can look at a spread chart by first typing in one ticker, for example, Coke, / another ticker, Pepsi, for example, very common example on pairs trading. And so basically what you're looking at is the relationship between Coca-Cola and Pepsi, obviously two very similar businesses. And the idea with short-term spread trading is when the spread becomes overbought or oversold. For example, here you would buy Coke, sell an equal amount of Pepsi, and then get out when it comes back to a technical fair value. And I've got a lot of experience in spread trading, pairs trading. After I left my role at a large investment bank in 2008, I actually created a spread trading software program, as me and a lot of other guys were doing that strategy almost solely back then. We were in a bear market, there was a lot of volatility, and it was working really great. And I ended up running that software for 7 years before I sold it to a larger company in London. And what I'd noticed from my time at the investment bank and working with proprietary traders is a lot of them would struggle with just doing outrights. That is, just taking outright longs or shorts on the market or any asset. When they switched over to spread trading, their results would dramatically improve. And that's because you can get returns that are uncorrelated to the market and anything else out there. And you don't need a bull market to make money when you're doing pairs trading. However, over time, I've moved more from short-term technical pairs trading into more of a medium-term tactical positions based on fundamentals and technicals, and taking trades that kind of complement my long-term portfolios and current view on the world. And so today I'd like to share with you a couple of spread trades I'm in and have on my watch list, with first being long ITA, short jets. So ITA is the ETF for aerospace and defense stocks, and just looking at a monthly chart, they're actually breaking out to all-time highs, and there's the monthly chart of global jets, which is made up of airline companies. There we are, there's a long-term chart of ITA versus jets, and you can see it's been performing really well for a long time. We've actually pulled back this last couple of months. And so apart from a technical uptrend, which you can trend follow in spreads, fundamental reason why I like this spread is because it's kind of long geopolitics, which is why it's performed really well since Russia first invaded Ukraine back in early 2022. And so buying the dip and this spread has worked really well. And not that I want global wars to escalate or anything like that to happen. It's more of a hedge on a long-term portfolio if it were to escalate, because if anything in Ukraine, the Middle East, Taiwan, China, Russia were to really spill over, then the defense stocks should stay propped up, as there'll be more and more government spending going towards them, and then travel stocks will fall sharply as well as people pull back from global travel if there's a lot of war. And that's what we saw in COVID. You look at this spread here. Back in January, February, March, after COVID kicked off from the start of January 2020, the spread actually rose 72%. That's because airline companies just shut down while defense companies kind of held in there. So that's one spread that I like in the medium to long term. Another more long-term one that is currently really oversold is long clean energy, short fossil fuels, in the spread of PBW versus XLE. Another one I'm watching is gold miners versus gold. They've been underperforming for quite some time, even though gold's breaking out to all-time highs. One that has been working really well for me of late, even though I'm a long-term believer in Tesla, long-term holder. As a trade, what's been working well is long General Motors. Short Tesla, been ripping up, really strong momentum and trend. And I based this trade, like a lot of my trades, on fundamentals, just looking at my fundamental chart layout here. General Motors, currently undervalued. It's got really high shareholder yield. And looking across its factors, they're either okay or pretty good. However, just looking at Tesla, my fair value indicator is still saying it's overvalued by 37%. It's got negative shareholder yield and it's got bad momentum. Another spread I've shared with you guys recently is long the BlackRock Bitcoin Trust IBIT versus short MicroStrategy. And even though the momentum is great and MicroStrategy's on a huge run, the fundamentals are really bad. It's pretty much just a crap company that owns a boatload of Bitcoin. So it's just a levered bet on Bitcoin. However, my theory is we're eventually going to see a correction, if not crash, in which case the underlying Bitcoin should hold up a lot better than MicroStrategy. But please keep in mind, this is very risky spread trade. Positions in this should be really small, as MicroStrategy could keep running further. That's why it's always best to dollar cost average into these spreads. Similar setup as long NVIDIA, short super microcomputer. Again, on my fundamental indicators, NVIDIA scores a lot better versus super microcomputer. Again, any correction in the AI space, I suspect NVIDIA will outperform, and it's already showing technical signs of a bullish divergence. And so you can perform technical analysis on spread charts as well. So you're just looking at the relationship between two stocks. Another one I've shared with you guys recently is long cannabis, short tobacco, in the form of being long ETF MSOS and short Philip Morris, largest tobacco listed company out there. Again, that's more of a long-term trade as well. Another one I'm watching is long silver, short gold, and just going out to a long-term monthly chart. Silver's almost the cheapest it's ever been relative to gold. I'm just watching it for a potential breakout. Another one's long value, short growth. Again, on the long-term monthly chart, value has been significantly underperforming growth for many years now. However, I think we could be holding support here that's been forming over the past couple of years. Similar setup as long value, short momentum. Another one I think is really technically oversold and getting a big valuation gap is long China, short Japan, getting technical signs that we could be hitting a bottom here on this spread. Another one that's been working well lately is long the software sector ETF, XSW, short the hugely overvalued Snowflake. And not only does it score really badly on my fundamental indicators, the CEO also just left after milking billions of dollars from the company, in which time they've also lost billions of dollars, and my stock fair value still thinks it's 70% overvalued. Another similar setup is long semiconductors, short ARM holdings. Again, ARM holdings scores really bad fundamentally, even though it's on fire now. And second last is long Bloomin' Brands, which owns a bunch of different restaurant chains like Outback Steakhouse, versus short Wingstop. Again, my fundamental indicators like Bloomin' Brands a lot more than Wingstop, even though we've got a lot of momentum in Wingstop, which could be stalling out. But again, small positions, dollar cost average. And I think eventually reality will set in on these spread trades like they almost always do. And least but not last, long PayPal versus short MasterCard. And looking at a long-term monthly chart, this spread has been beat down heaps the last couple of years. However, I've just added it to my watch list the last couple of weeks because I think we're technically oversold here. And don't get me wrong, I know MasterCard is a high quality business with a shared duopoly with Visa. However, I think that's more than priced into the market. 450 billion market cap. They're ripe for disruption. Got a lot of competition. The world's kind of changing. My indicators say it's overvalued. And I know PayPal's not perfect, not completely out of the woods yet. However, it has started to uptrend again. And I think it's undervalued, like my indicators are telling me as well. So I think there's potential for that one, even though it may be some time before it works out. So there's a look at 16 spread trades on my spreads watch list. And like I said, spread trading can really complement the typical long-only portfolios because you're betting on the relationship between two assets, not the outright direction of the market. And if you'd like to learn more about spread trading in detail and exactly how I do it and what I look for, then you want to check out Module 14 called Spread Trading in my online course. That's one of 25 modules, and in it I show you how to find spread trades, how to look for technical pairs that are co-integrated. I share with you my ETF pairs watchlist and trading view that I've already tested for co-integration, and much more other details. I also have 25 custom indicators on TradingView, many of which I use for spread trading, which I just showed you. And so if you'd like to get my course and my 25 custom indicators for TradingView, including my latest ones that I've shown you this week, sector analysis, shareholder yield, which has been proven to significantly outperform dividend yield and showing which stocks are likely to outperform over time. Same with quant factor scores, my third latest new indicator, and my portfolio monitor, which allows you to track all your holdings and get a bird's eye view of how they're performing, their RSI, the trend, daily change, and more. And I've been a premium member on TradingView for 9 years, in which I've developed develop these custom indicators. And so if you want to get these as well and stop using the free basic indicators that most people use, then come back to the channel next week because I'm offering an Easter special plus my indicators and the course if you want to get both. And then you too can do these spread trades, and just one profitable trade is probably going to cover your cost of getting these indicators in the course. So make sure you stay tuned in for that one, and I'll let you know how you can get it next week. Okay, just getting back into the daily review. The bulls are well and alive in this market, and why wouldn't they be? Everything's going for them. Momentum, profits, AI, J-Powell backstopping the market, and this could continue for some time, potentially market rallying even into next year, with another strong fundamental reason being corporate buybacks. That's when companies buy back their own stock, thus reducing the amount of supply of shares on the market, and that has historically caused stocks and the market to rally. And it's kind of a cheat, and it's something the government actually wants to tax a lot more of because it's not really a productive way to invest money in the economy. Nonetheless, it works really well for the stock market, and according to Goldman Sachs, they're expecting S&P 500 annual buyback this year clock in at $925 billion, up 13% on last year, just below the record we saw in 2022, and that's expected to grow even further next year, 16%, getting above $1 trillion for the first time ever. That's really strong tailwind for the stock market. All these companies, of which many have plenty of cash on their balance sheet, putting it to work by buying back their own stock. And it's not just large tech stocks anymore. There's many more sectors and other stocks participating in this bull market, including small caps, value stocks, commodity stocks, and non-US stocks as well. With the long-time laggard European stocks starting to come back to life, breaking out, looking really constructive on the charts. This is coming from a base of good valuations as well. And we can see that on the monthly chart of the Euro Stoxx 50 ETF FEZ, breaking out to multi-year highs here, and believe it or not, they're still below those 2007 highs. European stocks gone nowhere for 15 years. And this is just after we recently saw all-time high breakout on Japanese stocks, but the biggest international stock market laggard of them all is Chinese shares. Believe it or not, still trading below the great financial crisis lows of 2008. Even though their economy has multiplied since then, investor sentiment has been really weak these last couple of years. One could argue we're still completing a stage 4 decline, if not beginning a stage 1 accumulation pattern, which could still take some time before we eventually go back into that stage 2 advance. And that's probably good news. We've got a rotation not only happening in international stocks, but other sectors like I just showed you, aerospace breaking out, industrials doing well, financials, energy coming back to life. That's a good thing because we've got what was previously the most important stock of the market, Apple, falling by the wayside. It was already under weak investor sentiment for a while. Now we've got the Department of Justice, US government coming after them, accusing them of operating a monopoly in the smartphone market. And like I showed on yesterday's video, it's reminiscent of them coming after Microsoft 24 years ago. And according to Dan Ives, analyst at Wedbush Securities, said ultimately we do not expect any business model changes for now. It's effectively a kitchen sink case build up against Apple, although we believe this case will last for years and ultimately a settlement will be reached in some form, likely over the next 12 to 18 months. And I think that's spot on. I think this will drag out for years and they'll eventually pay a huge fine, probably in the tens of billions of dollars, of which many of the states coming after them could really do with to help out their deficit. And even though this is not a good thing for Apple, and definitely marked the turn for Microsoft shares back in April 2000, in which it took them 17 years to come back to new highs, it's not really going to change Apple's business. No other company's going to come in and take all this massive market share from the iPhone anytime soon. Speaking personally, my next smartphone purchase is probably going to be another iPhone. However, just like Microsoft in 2000, even though they remained a dominant business for many more years, still are, eventually recovered. I'll let you in on a little secret when it comes to investing, and that is pretty much 90% of your returns and whatever asset, stocks, bonds, REITs, is going to be correlated over the long term with the starting valuation at which you invested in. And so it won't happen every stock every year. However, over the long term, your returns will correlate with the starting valuation, of which Apple's isn't that great. My stock fair value indicator has fair value at $107 a share, well below where we're currently trading, $172, and with a PE around 27. That implies an earnings yield of 3.7%. And so that's quite a bit below where short-term bonds, money market funds are, still around 5%. And remember, Apple's not growing. It's actually had negative growth, not to mention their legal problems out of China, so on and so forth, and likely their huge margins when it comes to the App Store and other things to do with their ecosystem are likely to come under pressure from this legal standpoint, as competitors and developers now have the tailwind when it comes to this issue. So I'd be very surprised if we saw Apple get back to the old days of 15-20% annual growth in sales and profits, in which case the current valuations could be justified. However, if they're going to keep flatlining on growth, then this starting valuation for anyone getting in now isn't that great. And so going forward, it's quite likely possible 10 years from now, the stock's still trading around $170 a share after potentially having a bit of a drawdown in that time. And I'd be very surprised if we took out $200 a share anytime soon, maybe not for years. And they don't really have an AI product. That's why they've partnered with Google. It's kind of amazing with all the cash on their balance sheet. They haven't been able to innovate in that space. They too have been focused more on share buybacks. But regardless of that, we've still got others like the former bond king, Bill Gross, saying there's an AI-driven excessive exuberance in stocks. Said he's not buying bonds either. Said the ongoing AI frenzy and high federal spending are the main factors driving market records. And he's actually shorting 5 and 10 year notes as well, which is a view that yields are going to go up, which is well against the current narrative out there that yields are going to come down thanks to a Fed that's going to start cutting soon. Bill went on to say the fact that the stock market has been unaffected by the 300 basis point rise in the 10-year over the past 2 years tells an observer something. It tells me that fiscal deficit spending and AI enthusiasm have been overriding factors. And that's true. That's really well against the trend. When the Fed rises, which they did as hard and sharp as they've ever done before, normally that breaks something, at least knocks the market over. But something has overwhelmed that. And like Bill says, it's probably the AI rally, not to mention record federal government spending, which is a long-term problem, but in the short term, it just pumps a massive amount of liquidity into the system. On top of a modern-day Fed that artificially manipulates asset prices as well. They poured in $9 trillion of fake money into the market over the last 15 years. And it's no coincidence we've had an everything bubble in that time as well, which has 100% caused the sticky embedded structural inflation that we have now, even though the Fed and government will blame it on supply chain disruptions, Russia, blah, 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 anything else but their own actions. And so Jay Powell's pretty much talking like he's going to cut rates soon. Inflation's under control. It's not coming back. Kind of similar thing he told us in 2022 when inflation's transitory. But if he's wrong, the markets will definitely rebel and it could upset the narrative quite a bit. If he just can't cut rates because inflation's too hot, it'll look too much of an obvious political maneuver, then him and the Treasury, not to mention commercial real estate, other things like that, could be in a lot of trouble. And so remember, the government's acting for the here and now. They're not thinking 10, 20 years down the road. All the debt younger people are going to be left with and have to deal with. And we just saw congressional leaders sign off on another $1.2 trillion spending package, of which over 80% is going to defense. Hence why I like that spread trade. Long defense stocks, short airline companies, at least as a good hedge on rising geopolitical tensions, not to mention the huge amount of tailwind coming from the US government, which is trying to pull back on spending on every other areas except for defense. But for now, we just got bond yields kind of bumping around. They had been rising the last couple of months, and a sign they weren't so sure that the Fed could start cutting rates soon, and actually pushed out the date in which they were likely going to start the cuts. But now we've got no clear trend in the bond market. I can see that in the 2-year yield in my trend strength indicator. Being negative in orange just means there's no clear trend in the market. Same with the 10-year, kind of just bouncing around here between 380 and 430. And adding to the potential of more hotter inflation prints in the coming months is crude oil holding ground, which we could say is back into a short-term uptrend, potentially going into a medium-term uptrend. And there's a look at the action today, just pulling back, holding ground above $80 a barrel. And it was just late last year we were looking at high 60s a barrel. Really helped to get the inflation prints coming down into late last year. However, you can look at a chart of CPI and oil, and they almost look very similar. CPI has been holding ground, if not ticking up a little bit, as has oil. Now we've got agricultural commodities shaping up as well, which is more inflationary pressures. Not to mention the costs to move bulk goods has been on the rise sharply this year as well. Just moving on to cryptos, we've got Coinbase worried about these new ETFs, as they know they're a big threat to their business. They charge a lot more in fees and spreads for someone to buy Bitcoin through Coinbase versus the BlackRock ETF. Not to mention you have the third-party risk with Coinbase, which is a lot more than you'd have with BlackRock. And so the next step in this industry, which they want to get, is after Bitcoin ETFs, they want to get the second largest crypto, Ethereum, into ETFs. However, just like Bitcoin ETFs, we think SEC Chair Gary Gensler has been pushing back, trying to get Ethereum to be labeled as a security, and which would put it under his jurisdiction. And so this is still not a given and could really negatively affect the industry if Ethereum can't go through, or it could positively affect it if it does. But we won't find out until May when the SEC faces a final deadline to approve or reject Ethereum ETFs. And it's just funny how this has all come about. If you just go back a year or so ago, it was Sam Bankman-Fried and Changpeng Zhao, CZ of Binance, kind of the two kings of crypto with FTX and Binance. Government shut them down, and now Wall Street has taken hold of the crypto industry. But just remember, no matter where Bitcoin ends up, Wall Street will make money regardless because they get paid on assets under management, not performance. However, that's not stopping one of the worst fund managers of all time, Cathie Wood, saying Bitcoin could go as high as 3.8 million. And what a clown world we would be in then if that were to happen. She said the flood of institutional demand and higher portfolio allocations can push the price higher. In other words, number go up. There's no real fundamental discounted cash flow model or use case utility. It's just a prediction of people's perceptions and piling in on top of one another. That's pretty much the only thing that drives the price up because there is a limited supply of coins out there. She finished by saying, we're at the very beginning of really putting in place the financial ecosystem native to the internet and disintermediating all of the toll takers, of which she is one. Not only that, but in all her infinite wisdom, she decided to add Reddit shares to one of her ARK Fund ETFs yesterday. Even though the company, which is 20 years old, doesn't make a profit, did $800 million in revenue last year, of which they paid over $250 million to corporate insiders. She still thinks it's a good bet for her investors in her ARK funds. But again, she's just part of Wall Street. She makes money on assets under management, not performance. Because if she made money on performance, she'd probably be out of business. As her flagship ARK Innovation Fund, still trading at the same level as it was 6 years ago in 2018, and just overlaying the NASDAQ onto the ARK Innovation Fund. Since it came onto the market almost 10 years ago, it has drastically underperformed a relative benchmark. But somehow, investors have still got almost $8 billion of their money with her just in this fund alone. And the reason why she's chronically underperformed and is very likely to do so in the future is because she systematically buys overvalued shares. So it's kind of the opposite of the value factor. And when looking back through markets in hundreds of years, if you systematically overpay for stocks, you will underperform in the long run, even though you'll have brief periods of outperformance in market exuberance like we saw in late 2020 going into 21. Unfortunately, a lot of people loaded in here, and that's why even though her fund is up since 2014, overall investors have lost $14 billion in ARK funds. That's because she jumps on CNBC and media every day when things are hot. A lot of people pile in at the end of a stage 2 advance, then unfortunately throw the towel in at the worst time as well. And for some reason, the media still parades her around like a guru, even though a monkey throwing a dart could outperform her. But anyway, that's Wall Street for you. Very unlikely to change anytime soon. The best we can do as investors is just not playing their games, actually care about valuations and who manages our money. Also in news today, we got Trump's SPAC merger getting approved. That's Digital World Acquisition Corp, which owns Donald Trump's media company and the Truth Social media platform, which is kind of like a clone of Twitter. After he got kicked off Twitter, he went and created his own, of which he owns 60% of, and that could result in a windfall paper profit of nearly $3 billion for the former president, likely help him pay his huge legal bills, and could help his perceptions of winning the presidential election in November as well, if he's able to be successful with this. That'll trade under the ticker symbol DJT on the NASDAQ. And I'd say this is coming at a good time after a recent court ruling said that he must pay almost $500 million as part of a civil fraud judgment, and which is a huge record and very controversial to say the least. However, looking at the aggregate odds from sports betting sites, he's still the clear front runner to take the presidential election on the 5th of November this year. Still well out in front of Biden, with no real clear third candidate on deck either. Moving on, we've got another step in the right direction towards global legalization of cannabis, one of the world's largest economies, and largest in Europe, Germany. Beating expectations, after as expected they could kick the can down the road on this issue, they actually just went ahead and did it. Legalized cannabis, personal use, starting this Easter weekend on the 1st of April. Germans can now grow, carry, and use cannabis with the full backing of their government, and likely a strong signal to US political leaders that they are behind the ball when it comes to this issue. And so today's news was more of benefit to what's known as the LPs, the licensed producers, which come out of Canada, and they kind of kicked off the whole industry. And they already have a presence in Europe and Germany, like Tilray, which was up 18.5% today. Huge rip in cannabis growth, up 68%, massive dead cat bounce. And that's why we saw the ETF MJ, which owns LPs, rise 8% today. Even though MSOS pulled back a little bit today, that's because this ETF owns what's known as MSOs, multi-state operators. They're the producers and retailers of cannabis in the United States. they stand to benefit more from US federal legalization, which we're still hoping to get done this year before November. And there's still some positive movements in that space as well. Got Chuck Schumer, who, even though he's been dragging his feet on this issue for years and years, appears to be trying to get it done. But who really knows what their real motives are, since so many of these politicians are corporate sponsored and Big Pharma really doesn't want this to go through, pushing a lot of propaganda pieces out there as they're worried about this natural plant's threat to their pain management businesses. And so we're expecting potentially any day now, maybe next week, the DEA to reschedule it, which, believe it or not, is still currently on the same schedule as heroin in the category 1. Well, hopefully they reschedule it to category 3. After federal scientists just admitted for the first time there's medicinal benefits to it, and they actually told us all it's not as bad as heroin. So technically and fundamentally, this space still looks good, and hopefully there's more better things to come and we can break out above this high from early February, potentially over the coming days and weeks. Moving on to economic data, we didn't get much out today at all from the States. Retail sales in Canada coming in a lot weaker than expected year over year. Same with the UK, actually contracting retail sales year over year. Looking out to next week, got some housing data to start the week off, durable goods, consumer confidence on Tuesday. Thursday we'll get some GDP data, and then Friday we'll get a look at the Fed's preferred inflation gauge, personal consumption expenditures index, with that expected to have increased 2.8% year over year. Now, it'll be interesting to see if that comes in hotter than expected. Can the stock market just keep digesting that? And will Jay Powell keep saying, no, we're still going to cut rates, don't worry about it? Which for now, the market's thinking he's pretty much going to do. 75% chance going to cut in June. It's really interesting at this point of time, cutting rates with nothing breaking. But that's a big reason why we've still got the greed index sitting at 72. Market seems stuck in this mode now, and we can see that on the chart. Back here, the market was expecting the Fed to cut rates 6 times, and when Jay Powell pivoted to dovish, just went on a run. And even though in this time here, Fed fund futures have pushed out the date at which they're going to start cutting and repriced from 6 cuts to 3 cuts this year, stock market hasn't cared at all. It's just continued in this really tight parabolic range higher, and there's just no fear in this market. VIX sitting at 13, volatility risk premium still staying range bound, and volatility really low as well on the VVIX index. As a look at high yield bonds, just sitting at the top of the range. Another move up stronger today in the dollar index. There's Bitcoin just flirting with its 50-day VWAP. It's going to need a big green candle to hold onto this uptrend, otherwise below this yellow line could get more nasty, of which Ethereum's already sitting there. It's 50-day VWAP, so Bitcoin and crypto is going to have to show up next week to keep this uptrend intact. Another pullback in China and clean energy. There's Tesla still trying to hold ground above 170. New AI stock, Astera Labs, had another good day, up 9%. Reddit, not so much, down 8.8%. Other hot stocks, MicroStrategy pulling back today, and a little mixed for the others like DraftKings. Still got Wingstock in a technical uptrend, and same with Abercrombie and Fitch. There's still a bit of volatility in regional banks and soft pullbacks in the large guys today. All right, guys, there we have it for this week. Thanks very much for sticking with me and Click Capital. Looks like the grind higher is continuing in this market, and will be interesting to see what sort of inflation data we get this time next week and how the market reacts to that. Otherwise, be sure to come back to the channel and check out my Easter special next week for your chance to get my indicators in course at a deep discount. Thanks very much. Enjoy your weekend and see you next week. Cheers.